Okay, so hi everyone. Thank you for joining this special event being brought to you by Collier's residential team based in London. We've got clients joining us from across the world today, so thank you very much for taking your time to hear about this special report developed by our team. My name is Tony, and I'm the Completions and Channel Manager. And today's session will be presented by Ollie, who's our Deputy Chief Economist. We'll also be joined by Senior Associate Director from the International Properties team, Kevin. And we've got a Q&A section at the bottom of the screen. So if you've got any questions, we'll hold on to these till our Q&A section at the end. So over to you, Ollie.
Thank you very much, Tony. Yeah, good morning, everyone. Thanks for joining today's webinar, which will give you a preview of a report that we're going to launch probably early next week. Quick overview of the agenda for the presentation. So we just heard the introduction. Thanks again, Tony. I'm going to briefly present the research approach. How did we come up with the idea? Why did we do it? What was the actual methodology behind it? So for the technical audience, that might be quite an interesting few minutes. Then I'm going to talk about the 4 pillars that we cover in the research. So we analyze a lot of different indicators and we group them into 4 different pillars. Each of those pillars might be of particular interest to different groups, from investor to occupier to developer. So that will hopefully become clear when I talk about those pillars in more detail. Now, the main part of the presentation will deal with the city ranking. So I'm going to talk a little bit about the top 5 cities in our study. We analyzed a wide range of different cities and location. Obviously, I won't be able to talk about each individual city, but I'm going to present you with the top 5. And then, as Tony mentioned, we should have plenty of time at the end for Q&A. So feel free to use the Q&A function that you will see in the toolbar. Now I'll be speaking for probably around 20 to 25 minutes, so we should be able to wrap up well before 12. Right, so in terms of the research methodology, so the goal of our research study was to identify cities and locations that may be of particular interest to investors and to developers. And the research also identifies strengths and weaknesses across certain cities. Now, how did we do this? So we looked at a variety of different indicators, from economics over demographics, labor market, property indicators. We also looked at things that are important for the livability of a city, so such as broadband speeds, access to schools and leisure facilities, and so on and so forth. So it might be clear that there's a lot of data in this research, and how can you then compare all of those different data sets and then compare cities in an easy, digestible way? So the approach we chose to normalize the data for the technical audience is called the Min Max Standardization Process. And what it does, it simply allows to compare different data sets and to combine them. So some of the data sets may be growth rates, for example, GDP. Some of them might be just an index figure, for example, life satisfaction. Now, if you want to combine those 2 indices, you need some of normalization process, and we use the min-max method for that. I'm not going into too much detail on that. So what this method allowed us was to calculate a score for each city, for each indicator. So it means across the 20 different indicators that we included in the study, we have a score for each individual city. And you can then just rank those scores depending on how each city did in each of those 20 indicators. Again, it's a lot of information to take in, but I guess the bottom line of this approach is just that it allows us to rank cities based on those 20 indicators, where we just all combine them and we can have a simple ranking of all the cities included in the study. Now, we looked at around 25 different data sources, so official data sources such as the government websites for the different devolved nations, obviously the ONS data we looked at land registry, different house price providers such as Halifax and Nationwide, and also some other data sets, for example, Oxford Economics. And the result, as I mentioned, is a ranking that I will talk about in a bit. Now, before we go into the detail of the reports, I'd like to ask the audience the following question. If you don't mind voting, please. So which of the following cities would you consider a prime target for residential investment? And you can select more than one options. There should be a list on your screen now. So we've got Belfast, Birmingham, Bristol, Cambridge, Edinburgh, Glasgow, Leeds, London, Manchester, and York. And we'll probably wait around 20 seconds for people to vote before we carry on. But the results will be shown at the end of the session. Okay, thank you very much for voting, everyone. Okay, so if we talk about the 4 pillars first, as I mentioned, we have 20 different indicators in this study, and we group them into 4 different pillars, which you can see on the screen now. So the economics pillar deals with anything that is related to GDP and labor markets. So generally the economic health, but also the economic potential of a city. And I guess the economics pillar is important to pretty much every group, from investors to occupiers to developers. So it just tells you something about the health of a certain city and location. So again, I think this is important for everyone. The second pillar is the research and development pillar. And I think this is particularly important for businesses trying to relocate. You know, they want access to a qualified workforce, maybe to university research facilities, to a large number of students, to innovation, which is business startups. And I think the key takeaway here is that if a city attracts businesses and students, there will be higher demand for housing at the same time. So again, this is also important for property developers, also for property investors. The livability pillar, those are factors that draw people into a city. So these include things like access to schools, access to leisure facilities, life satisfaction, internet connectivity, things like that. And again, the same point that I just made for the R&D pillar, you know, this attracts people into a city, which will then likely result in higher demand for housing. The 4th pillar that we included is anything that's related to residential property. So we include house prices, we include affordability measures, both for purchasing a home, but also for renting a home. We also include the share of renters in a certain city. Again, we take the view in this research report that a high share of renters is a positive for, especially for BTR investors and developers of such assets. Now, a little bit more detail about each individual pillar. So this is a quick overview of the economics pillar. On the right, you can see a bar chart with the top 5 cities. And just a little bit of explanation what this chart shows. So it shows that the economics pillar had 5 different indicators. As you can see, GDP, unemployment, earnings, and the other 2. And the top 5 cities are displayed there with their individual ranking in each of those indicators. So again, we have 20 cities in this study. So each city ranks between 1 and 20 for each indicator. You can see Edinburgh, London, Slough, Cambridge, and Bristol made the top 5 in this particular indicator. And you will see in the following slides that the cities that made the top 5 in each pillar vary quite significantly depending on which pillar we look at. I think the main key takeaway on the economics pillar for us is that economic growth heavily depends on demographics, and that's a point that we consistently make across Colliers. What that means is that a higher growth rate of the population, especially the working age population, all things being equal, should result in higher GDP growth. And the chart on the left shows exactly that. So what I've done there is I've plotted the GDP growth rate from 2015 to 2025. So obviously includes a 4-year forecast. And that's on the x-axis. And then on the y-axis, I plotted population growth over the same period. And then you can see the dotted line in the middle, which is the trend line. And you can see because it's trending upwards, it means there's a positive correlation between the 2 indicators. If we look at the top right of the chart, we can see Edinburgh and Manchester. They have very high expected GDP growth. And this is in large part driven by their demographic profile. So population growth is expected to be a lot stronger than in any other city that we included in the study. Now, at the bottom left of the chart, we have the likes of Oxford, Sheffield, Luton, and Newcastle, Liverpool as well, where population growth is slower than in Edinburgh and Manchester. And a result of that is that GDP growth is also slower. So again, quite a significant correlation between the two indicators here. Now, there are obviously a lot of other variables included in the economics pillar, as I've mentioned. So we've got earnings, population, inequality, unemployment. But this just highlights how important demographics actually is for economic growth. Now, the second pillar that we included is the research and development pillar. And I mentioned before, so this is very important for businesses that are wanting to locate to a certain city, but this is also important for students. And in the research and development pillar, it's probably unsurprising that Oxford and Cambridge made the top 5 here. They have some of the most prestigious universities in the world. University rankings obviously very high. And the workforce is highly educated as well. It's more educated than the average UK city. London also made the top 5 again, actually topping the R&D pillar. And this is also driven by its innovation. So obviously, London has a massive population, has a large pool of businesses, and the concentration of those businesses in the population definitely play in favor of London. And then we've got Edinburgh and Manchester in there as well, completing the top 5. And one chart that I'd like to focus on here is the one shown on the left, which shows you the number of business births and business failures. And rather than looking at the absolute number, we adjusted this for population. Otherwise, you can imagine the likes of London, other cities with a large population just outperform everyone. But I think in order to come to meaningful comparison between cities, it's important to adjust for population. And on that measure, you can see that Manchester is actually the top performing city in terms of net business births. So that's how many businesses were created minus how many businesses have failed in a given year. That's displayed by the red diamond on the chart. You can see all cities apart from Leeds actually have a positive figure for net business births, which is encouraging. In Leeds, on the other hand, more businesses have actually failed than businesses that were created in this particular case. So I hope this gives you a little bit of an idea of which cities might be interesting for businesses and students that are trying to look into a certain city. And as I mentioned before, if a city draws businesses and individuals into the center, then this will also lead to higher demand for housing. The third pillar that we included is the livability pillar. And this includes any measure that draws people into a city. So things like access to leisure facilities and to schools, the number of attractions such as restaurants, pubs, museums, zoos, so generally things that you can do in the city. We also included life satisfaction and then also broadband connectivity. So what's the internet speed like, and how many people have actually access to, for example, full fiber coverage. Now, the ranking here on the right looks different to the rankings that we've seen previously. So we've got Belfast actually taking the top spot for livability. We also have a couple of new entrants here with Milton Keynes in 3rd and then York in 5th. Again, Cambridge and Oxford make the top 5 again. It's often reported that they are some of the most livable cities in the UK, and our study definitely confirms that too. And the one chart I wanted to focus on in the livability pillar is the one that's shown on the left, and that's broadband connectivity. And it shows you the full fiber coverage of a certain city or location on the y-axis, and then on the x-axis you can see the maximum download speed. You can see at the top right corner, Milton Keynes, Belfast, York and Bristol are performing very well. So very good internet connectivity, very good broadband speed. But then at the bottom left, we have cities like Luton, Oxford, Sheffield, Reading, Glasgow, Brighton, So they all have room for improvement in that aspect. So full fiber coverage is not as spread as in cities like Milton Keynes and Belfast. Again, and this just highlights how different cities do well in certain pillars, but they may have room for improvements across other pillars. The fourth and final pillar included in the study is the property pillar. So this includes anything related to residential property. So the indicators included are displayed on the right, 6 indicators included there, and you can see the top 5 cities again on the right. Again, we have a few new entrants here. So Belfast again takes a top spot here. House price growth is relatively strong. The rental yield achieved for a flat is high. The income to rent ratio and the affordability ratio, they are very favorable, which means people can actually afford to buy and to rent a home without having to spend 2/3 of their income. And you know, Sheffield, Glasgow, they're fairly similar in those areas. I think one of the important aspects of this is shown on the left. So this is the rental yield, which is based on an average flat. So not just across all property types, but specifically for an average flat. You can see how Newcastle outperforms every other location that we included in the study, with a rental yield north of 10%, whereas all of the other cities included are well below 10%. And I think, again, it's very important to just think about what is important for you as an investor or for you as a developer or even for you as a business. And if you're interested, for example, in high share of renters, where's maybe potential to actually increase stock of rental accommodation, this pillar might be very interesting to you. And again, I'm happy to take any questions at the end of this, should anything come up, because I can't go into too much detail. Otherwise, I'll be speaking for probably a couple of hours. So now that we've talked about the 4 pillars, we've seen that certain cities perform well across certain pillars, whereas other cities perform well across other pillars. And we haven't seen a city that outperforms every other city across all 4 pillars, which means there's generally strengths and weaknesses across all the cities and locations. I'm not going to talk about all of the cities, but I'd just quickly like to show you the top 5 cities in our study, and it will become clear where their individual strengths and weaknesses are. So each city has a chart that I will quickly explain, so you can get an idea of what it shows. So this spider diagram covers all 20 different indicators, which you can see outlined there. So from GDP over population, life satisfaction, rental yields, and so on. And the better a city ranks in a given indicator, the higher the bar on this chart. And it's also color coded, which means a dark blue bar presents a very high ranking, whereas lighter blue and gray bars present rankings where the city has certainly some room for improvement. And this should give people a very quick chance to identify those indicators where a city outperforms and those indicators where a city underperforms. And Cambridge actually took the top spot in our study. So the city ranks first for 5 of the 20 indicators that are included. And if we look at the spider diagram, we can see they're doing very well for earnings, qualification, university ranking, leisure, businesses, attractions. But there's also room for improvements across certain areas. So Cambridge's population and the catchment area is relatively small to the other cities that are included. Life satisfaction is actually relatively low as well. And rental yields and house price growth are relatively muted too, when compared to other cities in the study. Now, some of the benefits of Cambridge, obviously, I probably won't have to focus on too much. Prestigious university. Cambridge is actually more Nobel Prize winners than any other university, at 89. It's also called Silicon Fen, which means there's a cluster of high-tech bio businesses in the Cambridge area. So AstraZeneca, for example, the vaccine producer, they are based in Cambridge. But again, as I mentioned before, there's also room for improvement across certain indicators. And we have this chart for each of the 5 cities. So you should be able to quickly identify areas that are of particular interest to you. Edinburgh actually takes a second spot in the rankings. And if we look at this chart, we can see that they're doing very well in the economics indicator, which is displayed at the top right. So things like GDP, unemployment, earnings, and population. They're also doing very well in the livability pillar, which is towards the bottom left of this chart. So things like access to attractions, broadband speed, life satisfaction. And in terms of R&D, Edinburgh has a very good university. The workforce is highly educated, and student enrollment numbers are relatively high as well compared to the average UK university. So those are all areas where Edinburgh outperforms. Now, one of the things where the city can definitely improve upon, and that's the case for a lot of cities that have a high exposure to financial services or to the services sector in general, is income inequality. So you have a very small number of high earners, but also very high number of low earners. And that's one of the reasons why income inequality remains an issue. Income inequality then also results in affordability issues, again, which are some of the areas where Edinburgh can definitely improve on. Now, the third city in our rankings is Bristol. And unlike the other 2 cities that we've seen so far, Bristol is actually very balanced across most of the pillars, maybe with a slight downside in the property pillar. But you can see across the economic, R&D, and livability indicators, Bristol performs relatively well in all of those areas. So there are strengths and weaknesses across all 4 pillars, I would suggest. GDP growth is reasonably strong. There's not much income inequality, especially compared to the likes of London and Edinburgh. Obviously, Bristol has a prestigious university as well. And even in terms of the property indicators, if you look at the left of your chart, rental yields, house price growth are relatively strong and stronger than in most other cities that we included in the study. And Bristol is also one of only 2 cities that we included that doesn't score any lower than rank 16. So again, most cities have weaknesses that are a lot stronger than the weakness that Bristol has. One of the issues is affordability, which you may have guessed. House price growth is definitely stronger than earnings growth. And that's one of the reasons why affordability and also the income to rent ratio have room for improvement in Bristol. Now, London is a very interesting one, I think. So London comes 4th in the rankings. And if you just look at the chart, ignoring anything else, you can almost see a story of 2 tales, or of 2 halves, if you like. So London does very well across the economics and R&D pillars. So GDP, earnings, population, student enrollment numbers, innovation, as displayed by the number of businesses that are created. And so London outperforms most cities across those indicators. However, London does not very well across the other 2 pillars that we included. So in terms of livability and in terms of the property pillar, there's definitely room for improvement in London. So you can see life satisfaction is not very high. And then access to schools, attractions, and leisure businesses. While a lot of people would have guessed that London performs very well, again, we adjusted these for population, just to make it a bit, if you like, fairer to compare different cities. I think in absolute terms, obviously London would outperform all other cities, but then its population is 9 times higher than the second largest city. So that's why we adjusted for population. And in terms of the property indicators, again, no surprise that affordability remains a main issue in London. So London ranks bottom for house price affordability, but also for the income to rent ratio. So a very high share of income is spent on renting, leaving very little disposable income in the end. And again, this chart just illustrates quickly the strengths and weaknesses of a certain city. And then completing the top 5 is Manchester, and it's, I would like to say, similar to Bristol, where you have strengths and weaknesses across all pillars. So whereas London was very strong across 2 pillars and not as strong across the other 2 pillars, Manchester actually has strengths and weaknesses across all 4. So some of the strengths includes GDP in the economics pillar, student enrollment numbers, and innovation in the R&D pillar. Then we have access to schools, access to leisure facilities in the livability pillar. And then in the property pillar, Manchester does very well in terms of house price growth and the share of renters. And similarly, there are areas where Manchester can improve on, again, in each of the 4 pillars. And I'm not going into too much detail now, but we will certainly distribute the report once it's published, so you can have a closer look at all of the cities. Now, I mentioned we only include the top 5, but Belfast is quite an interesting story, and that's why we included Belfast as well. And what I mean by interesting story is, if we just look at the spider diagram here, you can see that it's highly skewed towards the left of this chart, which are the property and the livability pillars. And if we compare that to London, so I'm just going to go back to London, is the exact opposite. So London does very well across the pillars on the right, and then Belfast does very well on the pillars on the left. What does that mean? So we've seen in the 4 pillars that Belfast ranks number 1 for livability and for property. So very good internet connectivity, very good access to schools and leisure facilities, a high number of attractions such as museums, pubs, bars, restaurants, zoos, galleries, theaters, cinemas, and so on and so forth. So a lot of factors that actually draw people into the city. And then in terms of house price growth, the city is performing pretty well. House prices are affordable, renting is affordable, but there's still a high share of renters. So from a perspective of a BTR investor or BTR developers, there's a high share of renters. Renters can actually afford to pay their rent. And people are generally happy because they have access to all of those facilities. So, Belfast suddenly becomes quite interesting to developers and investors. And previously, it may not have been on the cards of those groups. However, there's definitely room for improvement in Belfast too. So in terms of the economic and R&D indicators, unfortunately, Belfast doesn't do as well as the other cities. And you can see here where some of the weaknesses are. So Belfast population, its catchment area are relatively small compared to the other cities. The average qualification of the workforce is relatively low as well. Student enrollment numbers are not as high as in other cities. Unemployment is relatively high. So there are definitely certain areas where the city can improve. But again, I think the main goal of the study was to identify indicators where cities do well, and then also identify those indicators where a city can improve, so that we get pretty much both sides of the story. Now that concludes the presentation, and I think we're going to look at the survey results first, the poll results first, before we go into Q&A. Okay, what do we have? So most people consider London a prime target for residential investment. I guess that's not a surprise, 70%. And then we've got Birmingham, Bristol, Cambridge at 44. That's surprising, I think. 32% said Edinburgh. But again, you can see at the top, only one person actually said Belfast would be a prime target for residential investment. And maybe this research and this report, give some. Maybe it's thought-provoking, that people might look to other destinations and locations now too, rather than just the traditional investment targets. So yeah, thank you very much for listening, and I will now hand over to Kevin, who will moderate the Q&A section.
Thanks, Ollie. That was a fantastic presentation and really, really thorough. And thank you for everybody who's maintained on the call. There's quite a few of you, actually. Ollie, we've had one question that's come in. Were the weights applied to all indicators, or were they equally weighted in calculating the rankings? Yeah,
no, that's a good question. So the way we applied the weights was we applied a weight of 25% to each of the 4 pillars. So each pillar has the same weight. But because the number of indicators within a pillar differs slightly, that means an individual indicator may have a higher weight. So an example is that in the property indicator, I think we have a property pillar, we have 6 indicators. So each indicator will have a weight of 25% divided by 6. Whereas in the, I think it's the R&D pillar, we only have 4 indicators. So the weight of the individual indicator will be higher, if that makes sense. So it's 25% divided by 4 versus 25% divided by 6. So we just want to make sure that each pillar carries the same weight. So that's why individual indicators have slightly different weights. I hope that's clear.
Ollie, that's great, thank you. That's actually the only question that's come in through the live Q&A chat session today. But if any of you online do actually have any further questions, please do send them in to either the residential team or to Ollie. In fact, someone has just mentioned other questions that's come through. The rental yield shown seems to be quite high. How are they calculated? Are they gross or net and against vacant value or invest value?
Yeah, so the rent, I mean, I agree that the yield seems higher than an investment yield, but what we've done here was we just used the average price for a flat in a city and then the average annual rent that is paid on a comparable flat. So that's how we came up with the figure. Again, you know, if you'd like to discuss that in a bit more detail, I'm happy to do so, but it's not the same as an investment yield, for example, that we see in the MSCI data set, or an office yield for prime offices. So it's generally just average price for flats and then average annual rent.
Thanks, Ollie. Another question. It's surprising to see life satisfaction so low in London, given the amount of amenities, restaurants, theatres, etc. available. Has this been influenced by COVID, do you think?
I would say no. So the life satisfaction data that's data from the ONS, and that's actually dated to before the pandemic started. So there's always quite a big delay in publishing life satisfaction data. So COVID wouldn't have had an impact on this. Now, I'm actually not surprised that life satisfaction is relatively lower than in other cities. And, you know, I agree. I mean, there are lots of positives in London, the ones that the attendee mentioned. And also, you know, there's actually a lot of green space. You obviously have a river in the middle of the city. But I think generally what I read in the media, or what's presented in the media, is that, you know, cities such as Oxford, Cambridge, Bristol, anything that's a little bit smaller than London seems to have higher life satisfaction. And I think, you know, part of that is commuting in London, for example. You know, obviously a lot of people commute into the city. They take very long train journeys. They work long hours. It's quite a busy and stressful lifestyle if you commute in rush hour. So I think that's probably one of the parts. I think emissions in London are obviously a lot higher than in any other city, which will have a negative impact on life satisfaction too. Affordability issues, you know, that's very relevant for London too. People are generally unable to afford buying their first home, whereas if you move, well, anywhere outside of London, it will become easier to buy your first home. So I think those are just some of the aspects why life satisfaction in London might be lower than in other cities.
Thanks, Ollie. A couple of people are asking if the slides will be made available, because there's a lot of information contained within them. We will actually be sending these out to all of the registered attendees over the coming days. A couple more questions have come in for you, Ollie. What extent do you think the ongoing shift to home working due to COVID has the potential to change the fortunes of these cities? Thinking particularly a shift away from the London-based working to places with good travel links into the capital. So are we seeing a migration, Ollie, of talent leaving the city?
Yeah, I think inevitably there's a short-term impact of this. At the moment we are seeing people moving out of the city. So all of the areas, for example, surrounding London is where house prices are going up, where demand is going up, whereas people tend to leave the city at the moment. But I think this will only be a short-term, not issue, but, you know, a short-term phenomenon. And I think people will realize that they actually want to be in the city and they want to have access to all of those leisure facilities. And I think over the coming years, there might be, you know, some form of reversal of this trend. You know, I'm not saying that everyone will move back into the city centers, but I think, you know, generally speaking, I think people want to be with other people. And I think, you know, the cities will certainly remain very interesting locations for people, you know, especially once everything has reopened, once the economy is open again. You know, obviously over the last 12 or 14 months, you know, there was not much reason to go into the office. I mean, obviously it wasn't allowed anyways, but what would you do after work? You know, you weren't able to go for a drink, you weren't able to go to the theater, to the cinema, and to access any of those facilities. But I think as we start reopening the economy again, we will definitely see a shift back towards people coming into the office and accessing those facilities.
Thanks, Ollie. A couple of questions around build to rent. To what extent does the report factor in supply of build to rent stock relative to its corresponding ranking?
So we haven't actually included a measure for the build to rent stock. And this is simply due to a lack of data availability. And obviously there's build to rent data on a UK level, and there's a split between London and not London, but it's very hard to get access to city-specific build-to-rent data. So that wasn't a factor in this study.
Okay, and the second question on build to rent, what do you feel the future of build to rent is when it comes to the provision of amenities in relation to the 15-minute city?
So I think build to rent is one of those sectors that will take off even more in the coming years. Some reasons for that are, I think the main reason is affordability issues. So with house price growth still outstripping earnings growth, this means that affordability ratios are declining and declining year on year. So it will become even harder for people to buy a property. But I also think lifestyle choices in general are important for this consideration. And the reason for this is that, you know, people may not want to buy and to commit to, say, a 3, 5, 10-year mortgage when they're in their mid-20s, late 20s. They might want to have some flexibility to actually be able to move around, not just within the city, but also move into other cities, you know, maybe spend a year abroad. So I think the build-to-rent sector is definitely becoming more and more important. If we look at investment volumes, for example, into the sector, they reached a record high last year. Now the sector is still very young, and I think it's only going one way, and that's definitely up.
Thanks, Ollie. Somebody's asking, have you or would you consider looking at London on a more granular basis instead of looking at it just as a whole? This is something definitely Ollie can do for you if you want to get in contact with him directly. I'm sure he'd be happy to answer any questions that you may have, if I'm not mistaken, Ollie.
No, that's right. So, I mean, obviously for the study, we couldn't break London down into different boroughs, and the data availability for some of the indicators that are included are tricky to compile at the borough level data. But yeah, as Kevin said, if you're interested in something more specific to London, there's plenty of stuff we can do. We can work with different parts of Colliers as well, actually. You know, some parts of the residential team are dedicated just to London. So if there's any questions you have, feel free just to get in touch with us and we can certainly look into that.
Thanks, Ollie. Did your GDP growth data include actuals from 2020? Yeah,
so the GDP data actually covers the period between 2015 and 2025. The reason for that is that 2020, obviously very volatile, very big decline. 2021 will be very volatile as well. But we want to include a general trend of the economic health of a city. So that's why we included the past 5 years and then also a forecast for the next 5 years.
Okay, thanks, Ollie. Cambridge had a low life satisfaction but fairly balanced graphic. Why do you think that is?
Why has Cambridge a low life satisfaction? That's an interesting question. Probably goes more into behavioral science. But I think part of that is actually the stress of students. So things I read before was that obviously the pressure on students in Cambridge is very high. Obviously, I mean, at Oxford as well. But I think because a large share of the population are students, there's almost a lack of population to counter that. Whereas other cities that are larger, you know, they have a more balanced population. So, you know, a large share might be students, but you also have a large share of workers and children and retirees and stuff. I mean, Cambridge is obviously skewed towards students. And I think because of the pressure of expectations I think that might be one of the reasons why life satisfaction is relatively low.
Thanks, Ollie. A couple more questions have come in for you. How much do supply side dynamics impact the attractiveness from an investment perspective? Is this something that you have looked at?
Yeah, I mean, supply and demand dynamics, we look at that all the time, and definitely it's definitely an important indicator for investors, I think. And I think that's why London will always remain one of the key targets for investors because of this lack of supply. So we cover certain indicators that look at supply and demand dynamics. And again, if there's any questions you have around that, feel free to get in touch if there's anything specific you'd like to know.
Okay, and then the last question, Ollie, is a little bit closer to home for you. Oliver, have you considered the German resi rental model, which informs your positive views on the future of build to rent?
I mean, obviously, I grew up in Germany, and I'm well aware of the residential market in Germany, and it's a lot more common for people to just rent for their life and not to buy at any point. And I think part of that is that rental controls are a lot stricter. You know, your landlord can't just increase the rent or kick you out. So the whole rental model is very different to the UK. Yeah, I don't know if that answers the question. I mean, I have considered the German resi rental market, yes. I don't think we are moving completely towards that, but I think the two are probably moving closer together. So, you know, in Germany, I think people are starting wanting to buy a bit more. And I think in the UK, it's slightly the opposite, that people are probably more likely to rent now than to buy. But, you know, from a personal experience, I mean, I was quite surprised. So I moved to the UK when I was 24 to study, and at university to do my master's. It wasn't just the undergrad. But when I first joined university, you know, everyone was just talking about buying their first home. And I thought, you know, these people, you know, they're in their early 20s, they're 21, 22, they have 2 years of their degree left. And all they think about is just, when can I buy my first property? Whereas in Germany, it's absolutely not the case. You know, you finish a university, you start your job, and then maybe once you start thinking about a family, you may start thinking about buying your home. But yeah, I think it's that was very eye-opening to me anyways, how everyone was just focused on stepping onto the housing ladder. But that was around 10 years ago, so things have changed a little bit since.
Ollie, that's great. Of course, you're very British now, and every man's home is his castle in the UK, isn't it? Listen, that concludes our presentation today. We've addressed all the questions that have come in, and I apologise if you could pick up on any background noise. I'm actually in the office today, so there's quite a few of us here. But if you do have any further questions, please do send them in. And thank you all for attending the video call today. I hope you found that informative. And as I said earlier on, the information will be distributed to you in the coming days. But thanks everybody for today.